Morning, guys. Bald Money Man here. I've been thinking recently about America. Let me start So, we're going to be starting off this series talking about something that I think a lot of us deal with on a day-to-day basis, but aren't really sure where it came from or why it got here, because it honestly doesn't make any sense. And that thing is money, right? So we have dollar bills nowadays, but before it used to be kind of like coins, and even before then, giant rocks by some ancient civilizations, like massive 100-pound stones, would be used as currency. It really begs the question as to how did we get to this point to where we entrust someone to pay us only using these bills, basically. If you think about it, it's kind of strange because you work every day and you pay for things and people make things just for this paper, and the paper by itself is intrinsically kind of worthless without the bodies to back it up. So today we're going to be talking about money. Just a quick assumption we're going to make before we start this video, and for every video afterwards in this channel, we're going to assume that having a moneyless society is either impossible or includes some workaround to include currency of some sorts. We're going to assume that for all the societies we're talking about and for all the civilization and systems that we're talking about in the videos, that it's going to be a civilization that uses money, and money is one of the main ways that it exchanges value between its people. I think a really good way to learn is to think of some thought experiments. And a thought experiment is basically you just come up with a scenario in your head and you kind of think through what's going to happen. For our thought experiment, we're going to start off with a very early civilization, maybe a couple of cavemen living in a couple of houses, and they each make their own thing. So let's just say caveman A breeds animals and he has cows and maybe some chickens, right? And then caveman B, he scratch that. Cavemen wouldn't have chickens and cows, so we're gonna move forward a little bit in society here. Actually, no, we're gonna move backwards in the items that they would produce. So caveman A, let's say, has discovered a cool new way to sharpen stones. So he has a bunch of really sharp stones that he wants to give out to people. And caveman B, let's just say he's really good at hunting, right? So he wants those stones, and in return he has a bunch of meat, right? And let's just say this is like a mammoth. So very large animal, a lot of meat, kind of hard to break up. The problem comes when caveman A, let's call him Grug, when Grug wants to give out his sharpened stones, how does caveman B, let's call him Dave, how does Grug give Dave his stones and get compensated for them? Well, Dave only has meat, but Dave has a lot of meat, and it really wouldn't make sense to give Grug a whole entire mammoth just for a couple of stones, and Grug doesn't have the capacity to make enough stones to pay for an entire mammoth, because it would take years, and he needs meat now. He wants to get rid of his stones now. So there's a really big barrier here, and trade isn't really possible without a way of communicating value from one person to another. So it really makes exchange better. And that is one of the biggest principles of money, is it reduces the friction in exchange of goods. This way, let's say that they had these small pebbles that they considered money. What they could do is say, Grug wants to sell Dave some arrowheads. So what Grug would do, we all know this because we do it every day, is Grug would give Dave the arrowheads and Dave would give him the stones. So in the long run, now Grug has something that is presently worth something. It's presently worth value, and he can give this to someone else and in exchange for other goods. And this really kind of reduces the friction in trading significantly, and it allows for smaller items to be bartered without having to save up the capital to make large purchases or large trades, basically, because you can't make purchases without money. So this kind of beginning of the thought experiment really takes care of the two, I think, biggest parts of money. Part one being that it is a medium of exchange. You can exchange value using an item, and that item will retain its value, and you can later use it to buy something else. Part two is it smooths down the friction of trade and barter, allowing for a more efficient economy, allowing for more people to get what they need quicker, and allowing for a culture or an economy to grow that much faster, because we won't have to wait for sums to build up so they can purchase things. Reason number 3 is because it is a hold of value. It enables long-term interactions and interactions over periods of time. So we can continue our thought experiment to kind of implement this rule number 3. Rug and Dave meet some female cavemen, and they produce more cavemen, and then they have a bigger population, and their kind of little civilization grows to maybe 50 to 100 people. So after growing to about 50 to 100 people, the civilization kind of splinters off, and some people go down further, a couple miles away, to make their own kind of like second civilization, you know, like a little miniature ancient Starbucks spreading across the land. And with that, they need a way to kind of communicate value to one another. So if they were to go back to a bartering system, if someone in the second village wants to purchase some arrowheads and all they have are cows to trade, they now have to grab these cows and physically move them from location A to location B. And what that does is it involves a cost of giving value to someone. And that really slows down and adds more friction. It kind of ties back into rule number 1. So if you had to give someone, let's say you make pottery for a living and you want to go to Starbucks and buy a coffee, if you got to carry a vase with you every time you want to go buy coffee at Starbucks, it's not going to be a good time for you. You're not going to carry a vase at 5 in the morning to Starbucks and give it to them for some coffee. And then Starbucks is going to have a bunch of vases in the back, and they don't know what to do with it because no one comes into Starbucks wanting vases. They want coffee. So it really allows for units of account to be held. Not only does it allow for distances to be traveled easier, but it also allows for time to be included in payments. Because if you have a 30-year payment, you can't pay with cows. The cows are going to die or move, or they can get sick, you know. But money, on the other hand, as long as you have a strong centralized thing that's providing it, some authority that's going to ensure the value of it, then you can use it for longer periods of time and take out loans and credit and stuff like that. But we can talk about that in another video, more complicated than this subject. We've gone through a medium of exchange. It removes the friction between transactions. It allows for long-term and long-distance trading. And then finally, it's a unit of account, which in our caveman thought experiment kind of isn't really too useful, but in modern day, it's very, very important. So basically what a unit of account means is that it's something that allows financial experts or bankers to put a value on what you own. So if you have a farm or you're Grug and you have your bunch of arrowheads, those arrowheads are worth different amounts to different people. A hunter might value those arrowheads very highly, but maybe a gatherer would not want to buy those arrowheads. The hunter thinks you have a high net value, but the gatherer thinks you have a very low net value. And that makes things very complicated when dealing with large transactions, availability of credit, how much collateral you can put behind actions. And nowadays, if you're doing large-scale things like buying a house, buying a car, building a business, starting anything that requires a large sum, people need to be able to put a value or a unit of account onto you to know how much they're really risking by lending you the money. So that's the fourth and final one, which kind of gets more complicated and away from the central idea of money, but we can talk about that in later videos and kind of describe how credit and loaning works. So those are the 4 main uses of money, but there's also a really other important factor, and it's what can be money.